ETFs are exploding in popularity. But are they actually a smart place to put your money in 2026? Let's break it down. Hey everyone, welcome back to ETF Shark, the channel where we break down investing in a way that actually makes sense. Today's video: what are ETFs and should you invest in them in 2026? Let's get into it. What exactly is an ETF? An ETF, or exchange-traded fund, is basically a basket of investments. This could be stocks, bonds, commodities, or even entire sectors. Think of it like buying one shopping cart filled with all the items you want, instead of grabbing each item individually. You buy one ETF and you instantly own a slice of everything inside it. ETFs trade on stock exchanges just like regular stocks. That means you can buy or sell them instantly during market hours. Prices change throughout the day. Fees are typically lower than mutual funds. Different types of ETFs. Let's run through the major categories you'll see in 2026. Broad market ETFs. These track entire markets, like the S&P 500 or the total U.S. stock market. Example: low-cost, diversified, great for long-term investors. Sector ETFs. Want exposure to tech, clean energy, healthcare, or AI? Sector ETFs do exactly that. Bond ETFs. A way to get steady income and reduce volatility in your portfolio. Thematic ETFs. Think AI, robotics, space exploration, high potential reward, higher risk, and 2026 has many new thematic ETFs popping up. International ETFs for investors who want global diversification beyond the U.S. Why ETFs are so popular in 2026. Here's what's driving the surge: lower fees than ever. More ETF choices, especially in AI, energy, and emerging markets. Better tax efficiency compared to mutual funds. Ease of diversification. One click buys dozens or hundreds of stocks, high liquidity. Easy to get in and out as markets change. Should you invest in ETFs in 2026? Let's break this into 3 common investor types. Beginners ETFs are one of the best ways to start investing. They're simple, diversified, and affordable. A broad market ETF is often all you need. Intermediate investors. If you want more control, ETFs let you tilt towards sectors you like: AI, clean energy, real estate, bonds, dividends, and more. Advanced investors. Factor ETFs, leveraged ETFs, and thematic plays can be tools for strategy, but they require more research and risk management. What to watch out for in 2026? Not all ETFs are good ETFs. Here are red flags. High fees, especially for thematic funds. Low trading volume may lead to wide bid-ask spreads. Narrow themes, too specific, too risky. Overlapping holdings. You might think you're diversified, but you're actually doubling up on the same stocks. You also want to understand what's inside the ETF. The holdings, the weighting, the expense ratio, and the risk level. Final verdict for 2026. Here's the bottom line. ETFs remain one of the most powerful, flexible, and cost-effective tools for building wealth in 2026. They're great for long-term investors, beginners, anyone seeking diversification. Anyone who doesn't want to pick individual stocks. Just stay mindful of fees, liquidity, overly trendy themes. If you found this breakdown helpful, hit that like button, subscribe to ETF Shark, and drop your questions below. I respond to comments. Thanks for watching, and remember, keep it simple, be consistent with your strategy, and stay diversified.